Now, the man I want to talk about here is one man's tax return. He happened to, at the time, be the richest man in America, the highest wealth in America. He's one of the most successful entrepreneurs in U.S. history. As I mentioned, he's one of my heroes on his business acumen. And he's also my hero because he's transparent. And he said what he did, and what he did was perfectly legal, perfectly correct. And this is a man named Warren Buffett. He reported his personal income tax and his personal income returns in a letter to the editor of the New York Times. In this letter to the New York Times, Warren Buffett said that he paid less taxes in his office as a share of his income than any of the 20 or so employees in his specific office. He paid 17.4% of his income in taxes. The next lowest person was in the 20s, and I think it went up as high as in the 30s on the other 22 people in his office. Now, he also said that he paid income taxes, almost $7 million in income taxes. Now, I took his income tax paid, a little less than $7 million, and I divided it by 0.174, and that would give me what his taxable income was. Now, his taxable income that I infer from his tax rate and from his tax payments of being a little less than 7 would be a little bit over $39 million, which is a lot of money. And don't get me wrong. I then looked at that taxable income, and I understand that the man gives away a lot of gifts, very charitable gifts. Phenomenal that he is generous, and he's extraordinarily generous. But the tax codes allow for a reduction in the adjusted gross income to calculate what your taxable income is, allows for deductions up to 30% of your adjusted gross income can be deducted if you've had the charitable contributions, which he has. So I assume he took all the charitable deductions he could legally. So I took his taxable income, which is a little less than $40 million. I divided it by 0.7, and I got his adjusted gross income. Now, we economists have definitions for income that are slightly different than the IRS. In fact, they're a lot different than the IRS. There are a lot of things that the IRS categorizes as income that we don't think is income. There are a lot of things the IRS does not categorize as income that we do consider income. I'm going to take you through this, and this is called the Hague-Simons definition for income. Any of you who are a little nerdy and want to look it up, look up Hague-Simons definition of income. But the definition of income, just for our purposes, is how much do you spend during a period? How much do you give away during that same period? And what is your increase in wealth during that period? Do you follow me there? How much do you spend? How much do you give away? And what's your increase in your wealth from the beginning of that period to the end of that period? That is your total income. So I put what he spends during a year, I took a 0. It's obviously a little higher than that, but I don't know how high it was, but I assumed it was 0. Then I looked at what he gives away. At the very lowest amount, I put that he gives away about $2 billion in 2010 to charitable organizations, 501c3s, which are charitable organizations, which is a very, very large amount. So I have, what did he spend during the year? I assume 0. What did he give away during that year? I'm going to take it at the low end of $2 billion he gave away during 2010. And now the last component of income is what was his increase in wealth. If I got the numbers correctly from Forbes at the time, and I'm just doing it off the cuff here, but at the end of 2010, I think his net worth, which is almost all in Berkshire Hathaway stock, his net wealth was about $50 billion. At the beginning of the year, it was somewhere around $40 billion. During the year 2010, his net worth increased by about $10 billion. Now, there are lots of other things that happened. He does all of his stock trading. He has no capital gains, or if he has any, it's really little, because he does it all below the corporate view of Berkshire Hathaway. Berkshire Hathaway, I also believe, is an insurance company which has other tax advantages. all of which are perfectly legal, and all of which are not only perfectly legal, all of which I admire the man for being able to be so good as to be able to use the tax codes to help the shareholders as much as he possibly can in Berkshire Hathaway. But what I get coming out of Warren Buffett's situation is that this man, the wealthiest man in America at the time, had an income on a Hague-Simons definition of around $12 billion. And he paid taxes of a little less, income taxes and payroll taxes, of a little less than $7 million. This man's tax rate wasn't 17.4% in his income. This man's tax rate was more like 0.06% of his income in taxes. This is what I'm talking about legal tax sheltering, legal deductions, exemptions, exclusions, shelterings, credits, all of this. What I'm saying is here is if I went back to the numbers of measured of income inequality, this person's income would be considered somewhere in the range of 62 million or 40 million. It would not be 12 billion, which is where it should be. So therefore, by using these deductions, exemptions, and exclusions and credits and all of that, he is able to reduce his pre-tax reported income dramatically. And yet, the people who measure income inequality would not catch that at all. This would reduce it. Now, does his true income fall? No. His true income doesn't fall at all. But does his measured income fall? Yes. Why does he use these tax shelters, tax credits, tax deductions, tax exemptions? Because tax rates are high. You know, what I told you before on tax rates is that when tax rates are high, people operate on the margin. And when you tax rich people a lot, they look around very, very hard to find ways of not reporting taxable income.